Yo, what's up you guys, welcome back to another video, and today we're going to talk about the CPI data that got released today. Now if you're new here, the sub would be appreciated, and if you do enjoy the content, please do consider smashing that thumbs up button for more educational content. Now it says here that inflation obviously rose 4.9%. Basically what they mean is it came down because it's a positive. They say it rose. The previous month we were at 5%. This month we met the Dow Jones expectation of 4.9%, basically signaling to us that inflation is slowly cooling down, which is not good for the dollar that's holding on to life support. Now, to give it to you in layman's terms, a weaker CPI means the Feds are less likely to hike the interest rates, mean that you can expect the dollar to weaken, indices to increase in value, the job report to look like a dead, because consumers will have more to spend due to no interest rate hikes or further interest rate hikes by the Federal Reserve. It basically, it's a whole article over here, but it says here, the consumer price index, which measures the cost of broad swaths of goods and services, increased 0.4% for the month, in line with the Dow Jones estimate. Now this is good news for consumers, not good news for the dollar or for investors, but we're not here to speak about them. However, what we do now know is the Feds are less likely to hike the interest rates, although we know that last week Jerome Powell came out after he did the 0.25% basis point interest rate hike. He had signaled a pause in the inflation fight, which I don't understand why. And we're just going to go through this video very quickly and just hear and speak about what it is that is making a point of reference to.
Inflation has been moderating in recent months. The process of getting inflation back down to 2% has a long way to go.
So we obviously know that the target for the Feds is to bring down inflation to at least 2%, but we've seen that the Feds had struggled to get the inflation from the 9.1% that it was last year in July to the 4.9% to where it is now. So that means the Feds are less likely to stop with interest rates because they are still very far from the target that they are trying to achieve. Let's continue, ladies and gentlemen.
And is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long term.
So I'm just going to cut Powell short there very quickly. So basically what he's saying is that they've got a target of 2%. Right now, if you look at the interest rate hikes for 2022, since the start of 2022 up until basically up until 2023 or 2022 December, you would have seen the Fed started with a 0.25 or 0.50% interest rate. So the Feds were basically hiking interest rates for the entire year last year, firstly, and because of that they were able to achieve the the inflation that they have now, but they still have a target of 2%, right, that they need to achieve, meaning that they can't stop with hiking these interest rates. So what does that leave us with? Well, the Feds did say that they are less likely to be as aggressive with the interest rate hikes as they anticipated, but this does not mean that they will stop. They will continue, but at a slower pace. And every time we get a jobs report, if there's a wage increase, it basically makes room for consumer spendings. Lower inflation means a less aggressive hunt on the dollar index, and that basically means that we can expect the index to weaker in value as well until the Feds are going in with their aggressive hikes, which was the reason that drove the price of the dollar index up in the first place. Now, with low CPI comes obviously lower interest rate, meaning less investors being attracted at the moment, and the only thing that will determine the index at the moment is going to be the rate decision awaiting, I think, sometime next week or somewhere there. Not so sure. There we've got the USD. Actually supposed to filter this for the index alone. There we go, USD. So, and obviously wait for the interest rate decision. Other than that, the index is now well on its way to slip and trip further down below, because there is now signs of inflation cooling down. However, like I always say, we have to be reactive and not predictive and learn to adapt. But the only thing I'm adapting to is a break below this level on the retest. Definitely expect that continuation to the upside. As we can see, the market just completed this bearish pattern known as a head and shoulders pattern. So we definitely expect the market to continue that move to the downside. Guys, that is your news update for today. Thank you for your time. And as always, cheers for yours.